I mean, the first part that I have said is the journal. So typically the way it is recorded is that it is recorded in a journal and then posted in the T account. But the journal to the T account is exactly the same. Some books, they don't even show you the journal. They just directly show the T account. So the journal simply says exactly everything that you need for the T account. What is the account involved? Is that account debited or credited? And how much is the amount involved? So whatever we did here in the T, we do that first in the journal, and then the computer can be programmed to directly put it in the T. So you don't need to go into the T account and write it. All you have to do is to identify, okay, accounts receivable, debit, $350,000. Revenues, credit, $350,000. Then the system will take it from there. It will put the journal. It will take you to the ledgers. So at any point you can go and look at accounts receivable account. It will show the $350,000 there. So we have the journal. Then we have all these ledger accounts. Okay. So then we have what is called as a trial balance. So I'm going to just display the trial balance here for you. Okay. So the trial balance is very simple. You just go account by account and put the net amount, whichever side is more.
Could you increase the font, please?
Yes. But I would rather that you look at it on your computer.
Yeah.
The only reason is that if I increase the font, I'll have to be moving this around. Let me.
Yeah. The zoom in.
He's about to do that.
There on the bottom right side.
I was trying to do that. Go ahead. Yeah.
He was about to do that.
Yeah, that's what I was doing.
I was going to review it. It was different. I didn't know.
Okay. No, I did exactly that. Then I thought, okay, it's not showing everything, so all right, let's go. Okay, now if you take the cash account and do a quick, folks, listen. If you do a quick, say netting off on the cash account, you will see that the debit side is more than the credit side by exactly that amount of $390,000. So you take 860 minus all the amounts on the credit side. You will see that if you take the cash account, the debit side is more than the credit side by $390,000, which is exactly what you had on the table. You will see that overall at the end of the table, what was the cash account showing? 390. That's exactly what you're seeing here. Okay, so the pluses and the minuses, so if you look at the cash account, all the pluses are on the debit side and all the minuses are on the credit side. So there's nothing really new here. Okay, we could have just done away with the earlier one and just done this. That was fine. That would have been okay. All right. So what we do is we simply follow through exactly like that. So we start with the cash, then we went to accounts receivable, and accounts receivable you will see the debit side is 350, credit side is 260. So on the whole, it is a $90,000 balance on the debit side. So we follow through on the trial like that for every account that we have operated here. Every account should be listed. Okay, and then look at the net amount on the debit or the credit side, and then list it here as debit or credit. And then we go all the way. I just listed it this way. So all these are asset accounts, or on the asset side of the balance sheet up to this point. Then you have liabilities, accounts payable and other liabilities. Then you have the owner's equity, the capital stock, and then you have revenues and expenses. Right?
Yeah.
And then what you do is you just simply do a total. That's why it's called a trial balance. You do the total of all the debit balances and the total of all the credit balances, and that should balance to $985,000. Well, that's not, I mean, it's just an arithmetic number. It just tells you that you did your debits and credits correct. It doesn't mean that your accounting was done right. Because you could have just operated wrong accounts with the same debits and the credits, and the trial balance would still be okay. Okay, so the fact that you have the same 985 in the debits and the credit totals here, it just means that you did for every transaction you had a debit and a credit equal amounts. That's all it says. It doesn't say that the accounts were right. Okay? So it doesn't say your accounting was done right. That comes only through an audit. So far so good? Up to the trial balance, everything is okay? Right? So after the trial balance, the next step from the trial balance is simply your financial statement, which we already did based on the tabular format, but the trial balance gives you a ready way of doing the financial statement. So watch here. See here, the one that I have highlighted, that's your income statement. Revenues minus expenses, except dividends, I'm sorry. This is your income statement. Correct? So revenues and all your expenses. So you put these amounts in the income statement.
So whenever you have more, when you do the T bar or these, what is it called again?
I'm sorry?
When you do the debit credit system, when you have a higher amount in credit, it's going to go on the credit amount on the trial balance, and when you have more in debit, it goes on debit side.
Yes, that is correct. Okay. So these accounts with their balances, they go on the income statement. You're done with the income statement. Then the statement of retained earnings will start with the retained earnings, whatever is the beginning balance. Then you add the profits from the income statement, subtract out the dividends. So the dividends amount will be listed in the statement of retained earnings. Okay, the 20,000, and then you get the ending balance of retained earnings. And then you have the balance sheet, which takes into account all these cash, receivables, all on the asset side. Then accounts payable, other liabilities on the liabilities side. Then you have capital stock and the retained earnings that came from the statement of retained earnings. That will also be on the record.
Why is the other one called, why is it called an income statement? I know it sounds like an ignorant question, but I don't get it.
It's called an income statement because the term income in accounting refers to profits.
But if you said that like insurance expense, all your expenses go into your income statement. So if it's an income, it would be coming in, or just if you're paying it out.
I said income is profits. Profits is revenues minus expenses. So the term income statement refers to a statement where revenues and expenses are reported and profits are reported. In the United States, the accounting has borrowed the economist's notion of profits. Economists typically, when they use the term income, they typically refer to profits. So here in the United States, the term income means profits. Okay? So operating income means operating profits. Okay? So net income means the overall profits of the company.
But it could be a negative number, right?
Yeah, it's a loss. It would be negative because expenses are more than revenues. Okay. All right. So now we got the financial statements out, and the last part is what we call as the closing process. In the closing, what we do is, and I'm not going to, delve too much into it. In closing, what we do is we close the revenues, expenses, and dividends. All the three accounts are closed. So what do you mean by closing an account? Making the balance zero.
Yeah.
Okay. How do you make an account balance zero?
To take out that one.
I'm sorry. No, that's not. Listen, how do you close an account? You can close an account without even using it. What? You just put the equal amount on the other side. The account is closed.
A general journal.
There you go. The closing of the account is an accountant's, tool. An accountant can close an account by simply putting an equal amount on the opposite side of the account. So if you have, we can just simply close the cash account right now. Because the cash account is showing 390,000 on the debit side. You put 390 on the credit side of cash, the account is closed.
But that would be transferring the money to someone else, right?
But that's because it's cash. No, but you cannot just, you're right, you made an excellent point. You cannot just arbitrarily put an amount on the credit side of cash without putting the same amount on the debit side of somewhere else. You have to transfer. You use the word transfer, and that would be correct. So you cannot just arbitrarily close one account. There must be another account that is involved in the closing process. So what we do is that for the purposes of closing, we generate, and so the first rule of closing is that what accounts have to be closed? The accounts that have to be closed are revenues, expenses, and dividends. these three accounts have to be closed. So, close. Every period, whether it is 3 months, 6 months, 1 year, whatever it is, at the end of every period, these three accounts have to be closed. And so they start with 0 in the next period. But others, assets and liabilities and the owner's equity accounts, they all stay. They go on forever. So in some books, they use the term temporary accounts for these, and they use permanent accounts for the others. Those accounts that are not closed, they are generally called permanent accounts, and these ones that are closed are called temporary accounts. So how do you go through the closing process? Very simple, because that's the beauty of the debit credit system. Because what we do is we generate a new account. We will call that income summary. It's a new account that we never had so far. It is an account that is created, like any account, it has also a T. If this account is created only for closing. Okay? So we create this account for closing, and we kind of hold everything, all the closed accounts, we hold it here. So when you close the revenue account, what we do, we put, so I'm going to use a different color to represent the closing. So here is an account. So revenue accounts, I'm just going to call this C1 because it's the first closing entry. So we're going to close the revenue account by putting $350,000 on the debit side of revenue. That is zeroed out now, right?
Yes.
Debit and credits are equal. But you can't just arbitrarily put 350 here. You got to put 350 on the credit side somewhere else. That is here. C1. In C2, we are going to close all expenses in one entry. Okay? So we are going to close all our expenses. So let's take one by one. What are our expenses? So revenue is closed. So let's go through this. Accounts receivables, equipment, salary expenses. Salary expenses, and the other one here, cost of supplies used. So we need to close the cost of supplies used. So we put C2, 80,000. So here, C2. So C2 will get 80,000 here from the cost of goods sold. So cost of supplies used is closed. That's an expense, that's closed. Then we need to close salaries, right? So we have salaries expenses that have to be closed. Again, we'll call it C2 because it's just one entry. We can combine everything into one. So 150 plus 10 is $160,000. So C2 has $160,000 here. So salaries are closed. Then let's go here. Revenues, capital stock, dividends will
Inventory.
pay. Dividends will pay. Cash, inventory, insurance. So we close insurance
25.
25,000.
They all follow the C2 with all expenses.
Say that again?
They
They are all C2 because they're all expenses. That's an example of how in a single entry you may have 6 or 7 accounts. So in this one entry we have all these accounts being closed. Every one of them is credited and just one debit can go here. So you can total this all up into one number and put that number here. That's fine too. So we have insurance is done. Cost of supplies used is done. Prepaid insurance
Depreciation.
is not to be closed. Depreciation. So depreciation expense has to be closed. 10,000. So we have 10,000 here. Right? Is there anything we have left out? Are there any expenses that we have left out? Are these only 4 expenses? Go to the income statement and see how many expenses do we have there.
No, I only see one discrepancy. It's on for salary expenses, and the example you had an extra one called accrued expenses.
Oh, okay, okay.
Yeah.
Okay, that's fine. I mean, this 10,000 can very well be in a separate account called accrued expenses.
That's the only discrepancy.
That's fine. Anything else that we have left out?
25, 10, 10.
Right? All the expenses have been closed. So we are done here. We are done with all the expenses. Okay? So now what we have is that the income summary now itself has a balance. Why? Because it's 350 on this side, and if you add these two, how much is it?
35, 115,
240, 265, 275.
275, yes.
So the total here is 275 on the debit side, it's 350 here, so that's a $75,000 difference.
Mm-hmm.
Is that your profits?
Mm-hmm.
Did we report a profit of 75,000 on this problem? Yeah.
Yeah.
The net income was 75,000 in this case,
That's
right?
it.
That's your profit right there. So therefore, what we do now, as the next step, yes.
What about the dividends?
No, dividends will wait. We'll just wait. Give me
It's
one
for
second.
the,
So then the third step is what? The third step is to close this account.
that's why you're doing dividend.
The income summary that we created for closing, we need to close that too. So what we do, we put C3, we put 75,000 on this side, on the debit side to close this one, and we move this to retained earnings. So now we have C3,
Retainer.
75,000 here in retained earnings. Okay, now this is closed too. Okay. Finally, we come to the dividends. So dividends have to be closed. Where is your dividends account here?
$20,000.
So that's your C4, the last thing to be closed. 20,000, that goes straight to retained earnings.
So the profit is the dividends?
No, the profit is this.
You paid out dividend.
The dividends is not part of profits.
So
The
you
profits
can
of 75, that increases retained earnings. The dividends of 20 decreases retained earnings. How much the owners pay to themselves? Pay to themselves.
Just to clarify,
Yeah.
the 350 is the summation of the cash?
No, the 350 is in the revenue. The revenue is closed.
Oh, okay.
The revenue was 350. The summation of the cash was 390. The net amount on the cash was 390. We're finally done. So now all the revenues, expenses, dividends are all closed. Now we are starting a new period with new balances, zero balances in those three categories. And the assets, liabilities, the rest of them will continue the way it is. So cash will continue from 390, accumulated depreciation will continue with a balance of how much? $10,000, like that. So all the other accounts, the assets, liabilities, and capital stock will continue with 600,000. And this account, retained earnings, will continue with 55,000. Because this will go with 55,000 into the balance sheet. And it will stay at 55 until the next year comes around, when you again compute profits, go through the same exercise, compute the profits, compute the dividends, move it to retained earnings, you get the new balance in retained earnings, the retained earnings will go forward.
So that one means you made 75,000 profit and you paid 20,000.
You got it. Very good. Very good. Any questions? Any questions, comments, concerns? Okay, so what we are going to do now is to take a short break, come back, and then